Hi ladies and gentlemen, and welcome back this time to video number 3 in the mini series where we talk about risk control. Now we're going to talk about risk control before we talk about profit maximization, because even very famous day trading authors like Mark Douglas in his book Trading in the Zone will always say, ladies and gents, that professional traders control their risk, they don't control their profit. It just so happens if you become very good at controlling your risk, profit tends to come, which is a great thing about day trading. What we're going to do, ladies and gents, is we're going to talk about risk control, but it's fundamental that we understand risk. And there's two very key points about risk, ladies and gents. When you are trading, there are two fundamental risks in trading, and this is all about building a realistic expectation for not only the start of your day trading career, but also as you progress. As you progress to a proficient and successful trader, we always understand that risk is part of what we do. And there are two risks in trading. There's a risk of gaining money, otherwise termed a winning trade, and there's a risk of losing money, otherwise termed a losing trade. And I'll say again, ladies and gents, there's two risks in every single trade that you take. Now, risk control, ladies and gents, is fundamental to your trading success. So when we're setting and controlling your risk, we believe it is critical to determine two things. One, what amount of money are you happy to risk in a trade that you are about to take? And two, where does your stop loss need to be placed in order to stop you from losing money if the market does not go in the direction you intend it to? Now, as you've seen in the previous videos, we are very fond of trading a trend, and we trade with the overall direction of the market, or we could say the overall momentum of the market. So we are actually seeking to have the market move us through our profit target. Now, a point to note, ladies and gents, and you can write this down if you would like, we are not contrarian traders. What that means is we never ever trade counter cycle or against the overall trend of the market. That will be like standing on a train track waiting for a freight train to try and bowl you over and trying to stop that freight train with a pebble. It simply does not work. Now, another thing I'm going to mention, ladies and gents, in terms of terminology is stop loss. One, we don't want to get in front of the freight train called the trend, but two, we always want to trade with a stop loss. Now, the stop loss, as the name suggests, stops you from losing money if the market moves in the direction that you did not intend it to move. Now, in the example we're about to work through, where we're looking forward to the market moving up, if the market moves the wrong way for whatever reason it moves, we don't want to sustain a large loss. So not only have we decided the amount of money that we're happy to lose in the trade, but we've also set a stop loss in place. If you will, ladies and gents, the stop loss is your risk control mechanism. It is your agreement with the market that if you come against me, I only anticipate losing the following amount of money. Now, can I tell you, ladies and gents, you need to write this point down. Rule number 1 in trading, always use a stop loss. Now, there are teachings around that talk about not using a stop loss, but may I mention, ladies and gents, that if you don't use a stop loss, you're actually not limiting your risk at all. And as Mark Douglas and myself would say, that is a very stupid thing to be doing. Let's refer back to the chart we were just looking at, and what we'll do is we'll talk about progressive risk control. Now, here's our original trade that we identified. And I spoke about stair stepping earlier, ladies and gents. There is a phenomenal stair step that occurs in the formation of the signal, meaning that the buyers are clearly in command. How do we know that? The buyers have pushed up and they've created a high point. Now that high point is just here in the middle of the chart. So the buyers have pushed up, they've created a high point. The sellers have pushed down, but they've failed to go as low as they went before. Now, there are only two teams here, the buyers and the sellers, and if the sellers have failed to push lower, who's in command if there's only two teams? If the sellers are failing, guess what? The buyers are in command. So not only do we have the buyers in command of the market, we have an MDI indicator that is pointing up, telling us that we are likely to get a buy signal, and if we do, take advantage of it. Now, the seller failure point, ladies and gents, is a wonderful psychological spot for us to put our trailing stop. More on that, of course, in the course. Now, in saying that, great spot to put a stop loss, but what we can do, ladies and gents, is we can be very smart about our stop loss. This stop loss on exactly this trade was a 14 tick stop loss. Now, gold is valued at $10 a tick. So what does that mean? We've got $140 at risk on this trade. Now, if that fits your trading plan and that fits your agreement, i.e. I will not risk more than $140 on a trade, then you are free to take this trade. What we can do, ladies and gents, is we can actually be very, very smart about our stop loss and use a strategy or a tactic we refer to as progressive risk control, which means basically stop loss movement. Let me show you exactly what I mean by that. If we move our stop loss higher, we are risking less money. Now, I'll ask you a question, ladies and gents. If the trend starts to move in your favor and you start to move towards your profit target, why not move your stop loss even higher to reduce your risk? Say our goal in this trade is 14 ticks to $140. As we move our stop loss higher and higher, call it progressive risk control, we are risking less and less money in order to gain our $140. If our profit target was far larger, let's say, for example, it was right up the top of the screen here, around about $300 to $320 profit target, what happens when our stop loss moves higher and higher and higher? In fact, let me ask you a better question. What happens when our stop loss actually moves well beyond where we got in? With our stop loss being above our entry point, we actually have a wonderful situation we refer to as positive risk. Say, for example, your stop loss is sitting at $80 positive. What happens if the market comes back and stops you out at $80 positive? You take your $80 profit and you run. What we're going to do in the next video is I'm going to show you an exact scenario whereby you could have had a 10 or a 30 or a 14 or a 20 tick profit target, and you could have progressively but very deliberately reduced your risk to the point at which you had nothing at risk on the trade and a $300 profit. So what we're aiming to do is set our risk and then progressively reduce it to the point at which we have nothing at risk at all. Does that sound like a reasonable trading style? Does it also sound like a reasonable proposition called a zero risk trade? Let's move on to the next chapter, ladies and gents, and I'll show you exactly how to do it on exactly this chart. So let's move on to the next chapter.